Many people accept that specialization is the key to human advancement. Do you think that's true, or is there still a place in the world for the Renaissance man?
It is not true that specialization, over-specialization visibly makes you fragile because your field, may disappear. You see the success stories of those who over-specialize and happen to be successful. Okay, not the other ones. There's a huge cemetery of over-specialized people who have disappeared. Number one. Two, I don't know what he calls Renaissance man, but knowledge has not improved massively. People don't realize that we still have. You have the impression from seeing that you have about 1 million papers in social science, okay, that we have advanced knowledge. We have not. Read Seneca, and you'll see that in the moral sciences and a lot of fields we have not advanced that much. In the complex domain, we have not advanced that much. So being a generalist, as people were 500 years ago, is still feasible.
A black swan event is generally an extreme outlier. Is it possible to profit from these events?
Half the black swan is about saying that there are positive and negative black swans, and I kept talking about it. And antifragile systems are systems that are benefit from black swans. Evolution benefits from random events, otherwise we wouldn't be here. Natural systems are not just robust to black swan, but they're like what I call philo-stochastic. They love volatility. They love because evolution cannot take place unless you have shocks that purge the system in a way. That's what people call creative destruction. But there are a lot of things like that. Even economic life needs black swan to remove like people who don't belong there. But unfortunately, the governments, they prop up these people. If you jump, say if you jump 4 meters, you're gonna be harmed a lot more than 4 times if you jump 1 meter. Do you agree? All right, and if you jump 10 meters, a lot more than 10 times 1 meter, because if you jump 10 meters, definitely there's an obituary in the darkness saying for you, correct? So there's what we call acceleration. I noticed that in finance, as a trader, if the market is down 1%, say you make 100,000, the market is down 10%, you make 20 million from acceleration payoff. So that's what we call, let me use the word, negative convexity or convexity, concavity, whatever. So, or positive convexity in some cases. So there must be, then I noticed that everything in nature has to have this accelerated dose response, okay? And there's an argument, which is complicated, but let's say, so in other words, if you jump 4 times 1 meter, okay, it's a lot better than jumping 0, 0, 0, 0 than 4 meters. Do you agree? All right. So let's apply that to demand, okay? A fragile system in demand. And there was a part of our conversation way before people were aware of the supply chain. If you consume 100 1 year, say toilet paper, whatever it is, okay, and then 100 the next year, the average is 100. It's not gonna stress the system in the same way that if you produce 0 1 year, or demand 0 1 year, and then 200 the next year. What happens if you have hyperinflation? You have a deflation, then hyperinflation, all right? So that's exactly what happened with demand for anything, for bicycle parts to whatever. So have zero, demand went to 0 and then jumped, okay? And of course also the stuff like Peloton, demand went to 100 and then went to 0, right? So it was a lot worse than 50 and 50. So the unevenly distributed stuff, if you're fragile, you want the distribution to be steady when you're fragile, when you're out here. Right. You want the market to go down 1% one day and then 1% the other day. It's a lot better than 0 and then 2%. Right. Think that the effect is squares or whatever. So it's the same thing actually in price impact in the markets. If you want to buy 10 units, say $10 billion of whatever, stocks, if you buy them all now, you're going to have financial problems. You're going to move prices. But if you buy over 10 days, no impact. Okay. It's very safe for one reason. It's a utility. With high-paid bankers living around here, You see, have big Soho lofts, $10 million Soho lofts, basically your utility. Because they don't let it go under. It's when it's not the one you got to worry about. It's the saving it again that you have to worry about. The effect of saving it. Like we saved it in 2008 was what? The government debt. And it exploded. And then again, in 2020, they bought so much commercial paper and so many things. Again, all these things aimed at saving the financial system, bank-wise, have spillover effects, but they're going to save the bank system because you cannot operate without it. Plus, another thing has happened is that banks used to take a lot of risk. Since 2008, risk has migrated from banks to hedge funds. Now, it's less concentrated, but it still can be concentrated.
In what way can that be concentrated?
In other words, he has a friend who has a big fund that's larger than a lot of banks.
Yeah.
You see?
You mean Citadel?
I'm not mentioning names, right? So you have a lot of big hedge funds, you know, and but I guess they can be diversified. Hedge funds have skin in the game. In other words, the owner of the hedge fund has money in it, unlike a bank where you just have the upside, not the downside.
Of course, long-term capital management is the counterexample.
No,
They had skin in the game.
Okay, so there's two
became
things.
very systemic.
No, it is. The skin in the game is a disincentive, of course, but it also skin in the game is a filter. You see? So where are the people from? Is anybody from long-term capital management still around?
Last I heard, John Merriweather was 10 years ago trying to start a hedge fund.
There you go.
So, they're gone.
So if you can't recover, the skin in the game has fallen effect. The reason you don't see too many crazy drivers is because they're dead. Because you inflict risk on others, but you experience the same risk. So you tend to exit the pool.
So it seems then, maybe I'm misunderstanding, but that
Kenny Smith from Boston asks if there are any problems that you're really interested in right now.
Well, I mean, my central problem now is figuring out antifragility, which is number one. There are two things to it. Number one, defining it. Of course, it's something that benefits from volatility in black swan. But there's another problem that comes with it that's vastly more central to me. Is why is it that we humans denigrate the system's ability to correct themselves on their own? You see, because we act as if we were necessary for things to take place, and that's a big problem. This has killed people in medicine. You know, human intervention when Mother Nature can do a better job. We always tend to think that we're smarter than nature. We have that bias. So this is the problem I'm working on is how to mitigate that, how to replace that instinct with something that's not as harmful.
The first thing that happened was in March, April of 2020. It came out that Universa had posted a 3-month return of more than 4,000% on their positions, which was quite eye-catching and got a lot of news. I, reached out to Mark and was like, "Holy crap! How do you guys do that?" So that happened, and then I came across a paper that Nassim had co-written in January of 2020 about COVID, and it was a glaring warning to the world that this virus was very deadly, and people needed to take extreme precautions against what was coming. By social distancing, other things, advice to politicians that they needed to be very aggressive about this. And it kind of occurred to me, I know Nassim and Mark for a long time, and I thought, these two guys, we're in a period of extreme duress where lots of people are just kind of looking really bad. They're collapsing, they're losing money, they're making really bad decisions about COVID. Everybody is confused. These two guys seem to be coming out of this period of really, insane period, looking very smart. So I thought, what is it about their worldview that allows them to go into a period that makes a lot of people look dumb look very smart. There's something about that, that can map from what Universa does to what Nassim does. And it's this view of the world of, of black swans, of extreme events, of being prepared for them. And
know what class of events you should be prepared against. In other words,
which
know
he had been
where
thinking
they can
about
be
for
coming
years.
from. And pandemics, for me, was something I was working on since 2007. I even discussed it in the Black Swan. That what you have to worry about is a pandemic before a financial meltdown because of connectivity. We're no longer like in the 1800s where, you can have a crisis here and not there. Everything's so connected. And
it's exponential.
And that's in the financial world, and the same thing in the physical world. You see, the government has, because of the zero interest rate policy, has accumulated debt, but there's a lot of, that swelling of assets. There's a lot of profits for the government because there's such a thing as income tax, capital gains tax. So government has accumulated assets that people are not noticing during the bubble. Right? But overall, I'd say that people are conscious of the problem now, and I'm glad people are fighting in Congress. Because on one hand, you have a tension between, it's like optimization under no constraints. So you optimize social justice. You'd like to, but you need to have constraints. Like you have a wallet, you have what's in your wallet. And you can't borrow forever. And so people are conscious of it. And once you have the solution would be probably easier. Plus, we got, I think AI would do something, which is increase productivity in some domains, as we're noticing. The Google Scholar translator productivity, right? So a lot of things will come that, but so we're not Japan yet, and other countries will suffer more before we suffer.
Marge, I'm confused. Is this a happy ending or a sad ending?
It's an ending, that's enough.
What did it feel like to you to come to this realization, particularly at the end of October the 19th, knowing that you were one of the few people who had figured out that there was this abnormal distribution to financial market events?
I didn't think in these terms. I started calling friends to see if they're okay, and effectively, my cousin, at times there was no cell phones, so you go home and then you have black cord fever, you start calling anybody you know to just chat about the event, and I can't leave the apartment because Hong Kong may call, and something may happen. So, and I remember, as I was talking to my cousin, he said, well, there's a police downstairs. It turned out some guy, a fellow committed suicide on 72nd and 1st. So it tells you it was very close to home. But it's only after the event that I saw the panic. Sort of like one thing you learn from accounts of Roman legions, that when they got into battles, they have no idea what they're doing. It's automatic behavior. They're trained, maximum concentration. They don't think of anything until the battle is over. Then they realize, hey, you know what? I'm injured.
So going into that day, do you recall what the size of your positions was in nominal terms?
It was, okay, so to go back to the notion of nominal, it makes no sense to talk nominal because I was accumulating a lot of tiny options.
I see.
Tiny options. And I remember the P&L. In today's terms, it would be for the firm, something substantial in today's terms, but at the time, it was not the same.
What was it in dollars?
Compensation was not the same. It was in the tens of millions, mid-tens of millions. And in today's terms, maybe 60, 70, 80 million in one day. For a trader just set up at a time, it was
a
big.
lot of money.
And for a guy like me,
how did First Boston treat you?
They treated me very well. Because, very, very well. The problem is it was still a communist system where everybody had to share. And everybody had lost money except for me and another fellow. So it was of course we had some, but at the same time they treated me relatively well. You got to remember that compensation at the time was nothing like today.
Do you remember how much you got paid that year?
I can't talk about it. I'm not going to talk about it because, man, you call up someone and say what payoff traders had. But then, I didn't cash it immediately. It took me 2 years of bonuses to get the whole payoff. You see? But
So-
yes.
And do you recall how you traded in those intense moments of concentration? How were you trading through the day,
Yes,
the 19th and the 20th?
I remember the 20th. I get on a phone and I had set up, so on. I had a trading assistant also, and had 15 phones and 200 screens. It was not like today. And you're shouting on phones. We had direct line to the pit, and direct line to Chicago pit, one Philadelphia, and one to the currencies, one fixed income, and then talking to the board of trade. And I remember there was a fellow called Richard Dennis. I don't know if you've heard of him. He's one of the famous people. He was famous at the time. He was bankrupt. He went bankrupt that morning, right, on the open. There was a trend in Eurodollars, a rally in Eurodollars. A trend of rally in interest rates. Okay, and the guy was short Eurodollars, and then the thing went to his face, and he lost his fund, which at the time was substantial, like $50 million fund, something like that. So they were liquidating the thing. And I remember I had a huge delta in Eurodollars, right? I remember then vividly offering something, right, on a phone and selling it considerably higher. So the guy in the pit, called Tim, I'd tell Tim sell here, and he would sell much higher. So it was like in trading places. Have you seen that movie? I got one. It was like that, all right? So all morning, so we spent the whole day, all right, liquidating. But all morning, I remember we were selling above our offers. Just one here, one here, one here. I mean, you want to take time to unload your inventory. And sure enough, there was liquidation, and we got lifted on all our offers, and then of course came back. Interest rate came back to 300 on a day or something. So that was the first thing. Currencies went wild. All right, the dollar, of course, collapsed. Dollar yen options. We had options we had bought for $10,000 in inventory. They were selling for 17 million. Something crazy like in yen, all right. And the thing was going, all right. It was like it was out of control. So the big payoffs were in not in the main big currencies, but in the ones where the move was a big surprise, like Eurodollars or yen. Swiss franc had high volatility relative to others. It wasn't as bad for participants in it. Let me go back to COVID. In a way, we were lucky. COVID was a bad thing. It killed 20-some million people worldwide, very bad. But it's sort of like it taught us, all right? So just assume that the big one came before COVID, okay? So, and the internet saved us with COVID. Just assume if we didn't have, as a sequence, we had COVID, then the internet versus internet and COVID, okay?
Right.
So we were, but now we're more prepared for the next one. So we don't have a lot of selling to do, say, okay, you test at the border, you close the border, you do this, you do this, you do this. We know the game plan. And probably for generations it's gonna hold. And the Zoom, which, I mean, I'm sure you're fed up with it. Okay, I am fed up with it. He made me teach a class on Zoom. For me, going to a dentist is better than teaching a class on Zoom. But nevertheless, I mean, it allows us to function. So so we have things. So antifragile, there's the systems that have this property that without stressors, they get weaker. That's what I noticed. Doctors call it hormesis. And I figured out the modeling of it comes from convexity. Once you define fragility, you have the reverse of fragility. And it's the same equation, it's a minus sign. Because the minus, like one is concave, the other is convex. So you tell yourself if a system is antifragile, then it needs to be stressed, okay? Otherwise, it dies. And natural systems don't get information via the New York Times. How do they get it via stressors? So if you have a Mediterranean skin, I think you qualify as Mediterranean skin, you go in the sun, all right, what happens? You tan, okay? Why do you tan? Your body gets a signal that this is the intensity, so it's protection for 10% more intensity. I'm sure you have a gym here. You know, you have a gym in Dartmouth. There's a gym. You go to the gym, you lift 100 pounds. What happens to your body? It prepares for 110 pounds. It upregulates. So there are a lot of things. And now, what is the converse of it? The bad news is that if something needs stressors and doesn't get stressors, what happened to it? It weakens. You see? So just assume that if you spend 6 months in bed, no stressors, no germs, nothing, no classes, no Starbucks, no bad coffee, no nothing. Right? You're in bed for 6 months. And then you get out of bed. What happens? First of all, your bones, would be weaker. And of course, you're gonna first germ, and if you're in a completely germ-free room, you know what's gonna happen to you. Probably not gonna survive.
Right.
So there is this idea that you need stressors up to a point. You need some stressors, and things upregulate. And I learned that why I don't. One thing is maybe sort of I'm trying to explain why I'm not a good speaker. I don't want to be a good speaker. Effort to understand me, you remember more what I'm talking about. You upregulate. So,
if you don't believe in MMT, the binge that we had at zero was much larger than any binge we've had in the past. I mean, if you really do believe in comeuppance or hangovers, however you want to characterize it,
exactly.
We haven't had it because this has been the mother of all binges, but we haven't seen it. There are people, Nassim, that they argue with me all the time that the strength of the dollar, that they don't think it's ever going to change. So we're able to print. We're the country of record on the entire planet. We have this ability to print that's never going to go away. So we can spend as much as we want.
Yeah, I mean,
that's the MMT people.
No, MMT made no sense, but people bought into it because it was, again,
you can make a case for it because we can always print money because we are the dollar is the standard for the world.
Yeah, I mean the Germany was a power, okay, and they printed, okay, so it's not like
we've seen it. I know they seem to ignore history.
They don't have history books.
I sent them a picture of a wheelbarrow full of cash when they argued.
Though, to the extent you're right. And one of the things you did ahead of 2008 was you hedged. The question is, if you were an investor today, given this fragile bridge, what would you do?
It depends. If you can't tail risk hedge, which is, I'm not going to sell tail risk hedging because
you can. You can try to sell tail risk hedging if you'd like.
But if you're an individual, you have to be stay away from the two businesses you're going to stay away from. New technologies, okay, particularly the ones that are connected to AI, because it's going to be very unstable, and the other one is real estate. And if you're a professional in the market, make sure you're not naked long stocks.
Right.
I mean, it's very simple. You take a firm, you see how many suppliers they have. Well, odds are that in 2003, they had 18 suppliers for a product. But the accountants over time made them get one supplier in Newhant or Converge, all right? Like a very large firm that I know had 15 suppliers and now one in Newhant. Okay, but of course they deserve what happened to them.
Yeah.
Okay, but because it was cheaper, but things are not cheap. But there's a middle way. What's the halfway is if you need supplies, make sure that all your suppliers are not in the same basket. Okay. So,
right.
All right. Diversify. It's one-on-one diversification. Okay. So.
And skin in the game.
And skin in the game, of course. If you lose the other, so there's a lot of things you can do. But then, as a society as a whole, I think the job of the government is to protect us from tail events. That's my definition of government. That sort of, some people think the government, like in the EU, should meddle with how much energy your vacuum cleaner uses. I think that the rest of things the government is there for pandemics and things like that. Okay, that we have a reserve for oil, but we didn't have one for chips.
Right.
We have so we have to
or
identify
vaccines. We didn't have a reserve for vaccines.
We didn't have. We weren't planning for this event.
That's right.
And the only intelligent person, because from 2013 on, Yaniv Bar-Yam and I went talking to people, tell them, listen, the pandemic is coming, are you ready? The only place where these people had a game plan that was very precise, Singapore. Mm-hmm. And guess what? And the person retired, so it wasn't as good as when he was there. Phil something, right? He was head of civil service in Singapore. And he said, yes, and this is what we're doing for this. And he taught us, basically, we learned more from him than our argument. So there are some places, but not the job of the government is to have contingency plan in case of pandemic. And we know we're going to get that big one. I mean, COVID was very bad, but it was more like a dress rehearsal for the real one. Think about it, the antibiotic resistant strain that once it's out, plus with aging of the population, it will transmit. So there are things that will, that you got to consider. The problem is epidemiologists, I hope I'm not offending too many people, but epidemiologists, their models were using Gaussian, they were not using, power law tails.
Right.
When we wrote that in Nature Physics, the physicists got it right away. They say, how come they're not using it? They say, yes, they published their article, and people were shocked. It's a completely different culture.
Yeah. Why do you think that's such an untold part of the Black Monday story? The action in Eurodollar futures, the action in currencies?
Because it's a professional market, and the professionals the largest market was fixed income at the time. The largest market, and currencies, include currencies. But people, only professionals talk about these things. And these professionals involved at the time are dead. But Black Monday, everybody remembers what happened to IBM because they owned IBM, but it's not the same scale. See, yes. And plus there's another thing, you got to talk about, when you talk about the stock market, it has a large inventory, you see, but the turnover is nowhere near what we had in fixed income.
Black Monday has been described as your epiphany.
Yeah.
How would you describe it?
No, I mean, I don't want to talk about myself because there's an effect of false memory when you go back. But I remember some scenes that were quite vivid. But I remember that I did not expect the next day, which me would be Gold Tuesday, rather than Black
That's where
Monday.
you made more money.
Yeah, of course. That was the big day for me, is Tuesday, because that's when the action of Greenspan were vastly more momentous than when that happened in the stock market. You also have to remember that the stock market had high volatility relative to other things, and not that many people played in complex instruments because of that volatility. But yen, for example, didn't have a high volatility, so it fooled a lot of people.
If I'm not mistaken, talking about the equity market, the VIX reached a peak on Black Monday that it has never seen since.
Okay, there was no VIX at the time.
Right.
Okay, and even the VIX I consider it an artificial contraption, but it's general to see. So what I learned from Black Monday was that, number one, these things happen, and when they happen, everything you make elsewhere disappears. It took me another 30 years to figure out something I told you, 29 years was here to explain that unless you're hedged for a portfolio, unless you're hedged for events like Black Monday, whatever alpha, you think you're going to get, you're not going to get it. Because what I call the ergodic problem, because what happens is that if you go bust on that day, there's no alpha. And most people don't realize that if you have to shrink your portfolio and things like that. Now, since the Black Monday, I didn't really think about it too much, except that here I had some cash. Okay, I realized it hit me after a while that I could do something else in my life than trade, you see. I was in my 20s, it was time, I could figure out what to do. The problem is, I like trading a little too much, you see. So, particularly for these days where you feel deep in your guts that there's something you're doing right. It's not the money so much, Although the mind is like entertainment, form of it makes it easier. It was not. It was just, I like that.
So you learned some important lessons on Black Monday. What did everybody else not learn?
That these events are not outliers. The regular part of the system. See, so and there's a first mistake people made with Black Monday. Before Black Monday, those who wanted to do risk management went to the past and looked for the worst deviation, and it was something like 10%. So you had Black Monday, now, which was 2.2 times whatever the deviation. Now what do they do when they backtest? To Black Monday. I mean, don't you recurse? So there was a new field new field like 30, 40 years old field in science called extreme value theory. And it started with the Dutch who wanted to build to protect themselves. So how high should our protection be, right? So do you protect to the worst past? Of course not. It's logical that it can get worse, right? So you take the worst past and you multiply it by 1.5 or some factor, and you live with it. Yes.
If that's the case, why is it that people still continue to use models like Black-Scholes?
Because they don't pay for their losses. Someone else pays for the losses. And plus, if you're only going to be wrong one day, you see, and don't pay for your losses, so it's fine.
In other words, so long as losses are socialized, so long as there's moral hazard, people will continue to use these flawed risk management tools.
The losses don't have to be socialized. They could be just transferred to the taxpayer. To the shareholder. Like you work for a bank, okay, like the whale. The whale got what bonuses? $30 million bonuses the years before. And then he lost $6 billion. He didn't have to pay a penny of the $6 billion. So I call it the Bob Rubin trade, and you make $100 million over 10 years, and when a black swan event happens, you say it was uncertain. Nobody could have seen it, and that's it. So it's very easy to use a regular model that predicts a regular. That's sort of like it's very easy to sell people a seatbelt that only works if there's no accident. Okay, so it's going to be comfortable. And if there's an accident, they're going to die. So they're not going to complain, all right? So that's sort of the idea. AI is not a problem for several reasons. Number one, I happen to have my day job is I happen to do statistical modeling. And we've been doing neural net forever. Okay? Neural net in finance, and always failed, but we do it forever. Yeah. And also, people, what do you mean by AI? There's different things. There's machine learning, there's LLM, which ChatGPT is, and we'll focus on that in a minute. And then you have robotics. Robotics, do you have a thermostat in your car? You put 68 degrees. If it's higher, it shuts off. So we've had that forever, for a long time. Okay. So it's not like we're just, making it more advanced. But people were not afraid of thermostat, and now suddenly they think robots are going to take over the world, right? So we got other things to worry about before. But let me talk about ChatGPT. As a trader, I learned one thing, as an option trader. And I had a saying, if you have any reason to buy a stock or an option, don't buy it. Why? This was already in the price, okay? Now, let me explain what ChatGPT does, basically. It does is it takes all the conversation and gives you the most likely. Maybe not that precise conversation, but the most likely one that resembles it. And the first thing I did is try to trick it, because during the day I do nothing except bicycling now, and a little bit of math in the morning, and then the rest of the time I got time to kill. So I said, let's strip ChatGPT. Okay. So you go to the obvious point, is that what does ChatGPT? It's just verbalistic. It takes words, so you can trip it by either making it say two things that are contradictory because of this verbalism, but that's complicated. So I did that, of course, and say, oh, I got a home run. So let's see why ChatGPT cannot run anything. And let me tell you why. It's a great clerk, right? It cannot run clerk doesn't run, it assists. Let me explain the thing. The first thing is there was at the Congress of Berlin, there's been a war between, on one part, Greece and Western powers, the other one, the Ottoman Empire. And there was a fellow called Constantine Karatheodoris, okay, who was representing one power. So I asked ChatGPT, what was the function of Constantine Karatheodoris at the Congress of Berlin, where they had to sign a peace agreement, a treaty between Greece and Western countries versus the Ottoman Empire. Of course, it thought, because his name was Greek, and he was an ethnic Greek, that he represented Greece. Who did he represent? The Ottoman Empire, Karatheodori Pasha. So you know immediately, what does it do? It doesn't know the answer, but it gives you the most likely answer, okay? And that's exactly what's going to bankrupt you, because that's already in the price. I tripped it. Another one was my village, is Battle of Amiens. My village is a Byzantine village in Lebanon. So there was a battle that happened, according to the record, a century after the Arab invasion. So there was a battle between the Byzantine army and the Maronite, some Christian sect that was pushed up the mountain. So we asked ChatGPT, you know, what happened at the Battle of Amiens? And it told you it's between the Islamic invaders and the thing, because most likely the battle, you know, so when you take the corners, how are you going to make money? You're not going to make money with an existing idea. If it makes sense, you're not going to make money because it made sense. A lot of people tried, they failed, and you don't hear about it, okay? Because people don't, they don't talk a lot about the failure, right? So that was the idea. If you look at ChatGPT, it cannot come up with a theory of relativity because it's not part of the discourse. It would dismiss it. You see? So it is. So that's why I'm not worried about it. And you can't run anything. You're just an assistant. It's excellent if you want to write a condolences letter. It's always very complicated. I have friends who are Muslims, friends who are Jewish, friends who are Catholic, and then I have to make sure I use the right wording. You know, like you don't say ad vitam aeternam, to eternal life, to a Jewish condolences letter. I learned from ChatGPT, so you write one. You see, let his memory be eternal. Yeah. Okay, so for example, ChatGPT is great for that because it gives you the most likely thing that people say. But if you want to progress, you don't progress by saying the obvious.
These are the people running the fund have sufficient skin in the game, would seem to be a net positive.
Yeah, hedge funds are okay, but we have had the risky part, the ones that are most fragile, the private equity, and of course, by far, people who need funding. Because, I don't know if you realize, but since we had our 3 bottles of champagne, pink champagne, and like 4 bottles, whatever, a lot of pink champagne to celebrate Lehman's departure from this town. Since then, we put interest rate at close to 0. So when I was, a student, and for me an investment was something that generates cash flow. So you build something that generates cash flow. So you value cash flow and or residual value at the end, okay? And so you can tolerate negative cash flow if you're going to get some later on. Or so it's like us, if you discover gold later on. So the business model was cash flow based with a short-term or long-term cash flow. The world has changed, all right, in the funding world. What is the game now is who you're going to sell your company to.
I see. So you're talking about startups in this case?
Exactly. Startups or a lot of investments. You buy an apartment, you buy a house, you buy a building, you buy something, or you invest in some crazy idea. And someone was contacting me about LLM models, ChatGPT, by saying, we have this startup, I'm investing in this startup. And I looked at the rationale, and then he said, I'd be able to sell it in within 2 years. I said, listen, this is a trap, okay? So companies, say even Twitter was operating on a following modus. We go to the market, okay, as a cash machine. So you don't even have to generate cash. So basically everything came from, it has Ponzi characteristics. Someone else will buy our company, or we're packaging a company to sell it to someone else. Mm-hmm. Okay, now, That started before the great financial crisis, but it was very moderate. Of course, it took place during the crazy period of the internet bubble and then died. So we had episodes of that effect. But now it's ingrained in people who have for 15 years of low interest rates. You have people in their 40s who have never seen interest rates. And they don't know how to behave, they don't know how to invest. So I think the most fragile part today is not the banks, of course, as we said. And it's not hedge funds, because it's sort of like mature adults, typically. It is those startups and VCs and venture capitalists. But venture capitalists actually played quite a nasty game, because they cashed out. All of them are rich on companies that never made a penny. You see, I know there's a lot of, think how many billionaires you have in from Silicon Valley, right? Who ever made a penny? It's valuation, baby, as I say.
Yeah, there's a lot to that game. I will say also, I think there are going to be tremendous just fatalities in the next probably 3 quarters in the startup world, because there's been a lot of contraction of funding, which I think is ultimately probably a good thing. But a lot of these companies are raised.
It's a necessary thing.
Yeah, no, well, right. I mean, it's culling of the herd. So I think we're going to see a lot of.
But think about it. This will finally get waiters. Because we have shortage of waiters. Okay, we finally will get waiters. I mean, you go to restaurants and they have one waiter for the whole room, and so we get more waiters. We get more people who will help you mow the grass and stuff. I mean, we got a lot of supply.
Former startup founders serving you your Negroni. We'll see how it shakes out. I'm curious to see.
I was enraged during the pandemic at practically every single group, of different political groups. In the beginning, when we were waiting, we were a group of people, Yanir Bariam, myself, waiting, for the pandemic to emerge, to go back people to reduce connectivity. You don't need, all these things. All you need is reduce connectivity, and the Ottomans know how to do it. The Ottomans and Habsburg had something called lazarettos, quarantines. I grew up in Beirut. There's a quarantine, the quarantina, right? Had an Italian name. That was vessels would come in and put you for 40 days. Actually, quarantine was about 7 to 11 days, depending on where you came from. They had formulas. And the minute they hear a rumor of a quarantine, of a pandemic, or the quarantina, all right? So you had quarantines. We don't need quarantines if you have testing, you see? So it took us 13 months from the inception of COVID, right, to have testing at the U.S. border. And particularly, I don't know if you've been to JFK during, when planes come from all these places. And it looks like, the being in the subway car, everybody's contaminating everybody. So for 13 months, people didn't get the simple measures. So in the beginning, we started fighting for what we called exactly decoupling systems by putting fences around the system. So instead of lock in your house, you locked out. And so the second thing is we had to fight people in psychology departments, finding it irrational for us to worry about a pandemic that killed 5,000 people worldwide, when cancer was killing 5,000 people every day or something, right? So we couldn't explain to them the following reasoning. There's a fellow called Dr. Phil who went on television saying, at the time COVID had killed 3,000 Americans. He said, 3,000 Americans have drowned in a swimming pool. So, why don't we shut down swimming pools because people drown in them? Why do we shut down because of COVID? The response is, if I drown in my swimming pool, odds are that the neighbor is going to drown in his swimming pool, or that probability increased. Whereas the probability has not increased, right? Whereas if I die of COVID, the odds that my neighbor is going to die of COVID has increased. So you got to look at the multiplicative effect of these things and forget about standard statistics. Again, mediocre standard is what people learn in business school and statistics through classes. It's completely useless on a bell curve. The bell curve works very, very well if you do astrology. right? If you do astronomy, if you do medicine, it works, but it doesn't work in socioeconomic things. It doesn't work for pandemic.
Criticism, is that something that is inborn?
Maybe because I was never really someone who took established ideas at face value.
Mm-hmm.
So you necessarily have, violate some norms, some thinking norms. And often people protect those norms by, attacking your reputation. And I realized that while writing Fooled by Randomness, I say, hey, you're saying that what I'm doing is random, we're using the wrong models, it don't work. So they attack your reputation. So I realized quickly that it was time that my reputation was going to be under some kind of fire. And I decided that no, my reputation is how a few important people or people who know something about the subject view me. Mm-hmm. And it's not like I don't care about my reputation. I only care about my reputation in some circles. And it was people I can talk to try to explain what it's about. And it has worked out. Mm. So, but if you're if you have to go defend your reputation and you're doing the right thing, it's too much energy wasted and it's not going to help. Haters are going to hate. Mm-hmm. I think this resembles another aphorism inspired by Charlie Munger's. One of Charlie Munger's is that you want to be the most ethical person where people think that you're corrupt, or you want to be the most corrupt person where people think that you're ethical. Mm. Make your choice and use it as guideline. It's the same thing. So, except that there's something in between, is that there's some people I care about, and I want them, to not lose respect for me. Mm-hmm. And of course, you start with your mother, you have your children, or whatever, your family members. But there's a lot of people on the planet, and I care about my reputation, but in these circles, not with the general public. Mm-hmm. So it allows you to take much, much more aggressive positions, which I've done over a long life. And Mark, for example, has a lot of enemies. Mm-hmm. And they're going to pick on something, and you don't care. So you're doing the right things. And how do you know you're doing the right thing? If people you respect approve of your action, not if the general public does.
So that segues to my question for you, Scott, which is in the process of doing all of these interviews and interacting with these various players on the field, these sort of practitioners, these investors, and so on. Have you identified any patterns that you think, whether nature or nurture, that seem to recur in people who are good at what you describe in the book?
I would say, across all three books that I've written, which are generally focused on Wall Street, trading, hedge fund managers, I've met a lot of hedge fund managers over the years. None like this guy, I have to say.
We'll probably come back to that.
But
I'll tell you, I don't want to be identified as a fund manager.
Yeah, that's true.
It's an identity thing.
I would say that's probably why you're not like them. Many are very focused on making a lot of money. Mm-hmm. That's a very common trait. Mark, he talked to me about how, he grew up in the 80s. He identified with the, Reagan era. It was a time, Wall Street, greed is good. He told me, he's like, did I have a little greed in me? Yeah, I did. It was the 80s. He grew up in a family that was kind of, his father was a minister in a church. He was sort of a hippie, didn't believe in pursuit of wealth. Mark took the exact opposite view of that, and that was constantly something driving him, was the desire to make money. Mm-hmm. A lot of other hedge fund managers I've met over the years, just they have that drive. And it's something that many people look at these guys and think, you're worth $1 billion, you're worth $2 billion, and yet you're a maniac. You go into work every day and just go, crazy. You drive all your employees crazy because you want to be richer than the next guy. Mm-hmm. I don't think Mark has that, quite that sort of insane level of greed as some do. I've met Ken Griffin, the founder of Citadel, a disciple of Ed Thorpe, who we talked about, we might talk about later. Cliff Asness, who is a stark enemy of
yeah, a friend initially. Initially a friend.
Yeah, and I have to say Cliff is a nice guy when you meet him.
Not a nice guy, but I've had friends who are not nice guys.
He's also got a dark side. Also somebody extremely focused on being wealthy. Very smart. They're all extremely smart. And I think that's in personalities, that's I think one of the things that has helped drive my books is these are interesting people.
Yeah.
You know, a lot of them are mathematicians, scientists. They come out of university with a different expertise in making money, but then they apply that on Wall Street to making money. So it's a combination of, you know, a lot of them, they have to be leaders. They are extremely driven. It baffles me because I'm not like that. You know, I have a degree in English, and I think that's actually why I sympathize with Nassim's writing so much. Is I came out of a tradition that, you know, I love the works of Dostoevsky and existentialism, and you know, one of my favorite books is The Irrational Man. And I came into Wall Street and started reading about how there's this belief that people are irrational and the markets are rational and they are predictable because of this. And I thought that is just crazy.
In 1973, for those of you who were driving large car, you know you know what happened. 1973, there was an Arab oil embargo.
Oh, yes.
You remember that, of course, all right? And then the American cars in 1973, I don't know if you've seen pictures, but you pretty much have this conference in a car, right? They were very large, okay? So they were like gas guzzlers. Gas was free, and cars got bigger, and then there's such a thing as Las Vegas, where cars were so you had room. The cars were huge, okay? And 73 came. Now what happened after 73? Compact cars started to show up everywhere, okay? And the cars shrank, and the demand for oil dropped to the point that the state of Texas was nearly bankrupt. But definitely the Soviets were bankrupt. Okay? So it took like from 1973 to the early 80s for the adaptation to take place. Okay, so that's in the 70s. Now there is, I think, the Nobel Prize of, I don't know if there's no such thing yet for Nobel Prize for environmental studies. It should be given to Vladimir Putin, because by cutting the gas, it took Germany 6 months to adapt, okay? So he helped the cause of environmentalism, because what took 6 or 7 years of reduction in demand and adaptation and stuff like that happened in 6 months because of that Russian thing. He thought that it's going to be like the Arab embargo, and everybody's going to suffer, and the Germans are going to come to their knees to beg for mercy, give us natural gas, we need you, So God save Russia. But no, it didn't work because they adapted very quickly. Those clamoring for regulation are those the most threatened by AI. I was an arbitrage trader, and you know what regulation means, because you give me a country where they have a lot of regulations. You hire 3 lawyers. Okay, 1 lawyer is in Japan. Japan was the most regulated financial market. So you hire a lawyer in Japan, 1 in London and 1 in New York. Okay? And then the regulation, what does it do? It causes arbitrage, because there's some, you can't short stocks in Japan. So you can make tons of money. Wherever you have regulation, you can make tons of money finding ways to reproduce the same product built in another way. Like, for example, you can't go short stocks in Japan. So you buy the index. Okay, you buy all the stocks, but you can short the index. So you have a flat book, and someone wants to short a stock. You short the stock at a huge fee. You remove 1 stock from your long, so you have net synthetic short, for example. So this is an elementary trade, but there are more complicated trades. So So regulations I'm for skin in the game, not regulations. I'm for tort, because you can't game tort. You cause a problem, you pay for it. Regulations usually allow, I had a fight with this guy, he's at Princeton, he was vice chair of the Fed, trying to sell.
Bernanke?
No, another fellow. There's a fellow, I was in Davos, the only time I went, sorry? Alan Blinder. I was in Davos, and the fellow say, oh, it's incredible, this, how can we protect ourselves, the world I'm talking about. An American citizen, Citibank may go bust, how can I get cash? I'm in Switzerland, stuff like that. Oh no, I got protection, what is it? So, FDIC insurance, they insure you for per account, not per individual. So you give them $20 million and they open up, I don't know, it's 25 accounts or 50 accounts, something for you. And then therefore, I told him that this is unethical, because basically rich people can benefit. He said, no, we got a lot of former regulators on our staff. Then I started the crusade against regulation, because I realized that regulation allow regulators to later on sell their services because they know the inside. I mean, some regulations are necessary, but it's like speed limits. Some are necessary, but torts, all right, are vastly more powerful because they can't be gamed. And torts, and that's a left-wing concept. It started with Ralph Nader. So actually dedicated the book to Ralph Nader. Torts are vastly more robust than regulations. So I think with AI could be, you can use a tort system. You say you're responsible, but people to regulate, basically the regulations, people calling for regulation with AI either don't understand anything or they are afraid of it because it hurts their business. But think about it, if we slow down AI growth in this country and the Chinese develop AI, what happens? We're going to have to learn Mandarin now as first language because basically you're invaded, all right? So you have to realize that there is you can't really stop research on grounds that it hurts Elon Musk's business, okay?
And your prediction was right. Can you foresee any other crisis
that
will happen in the near future?
Yes, unfortunately. There's this debt crisis. I mean, of course, unless you strengthen, you modify that bridge. We have a fundamental problem at the core of capitalism that will blow it up. And it's what I call the agency problem. This asymmetric payoff I have. A manager of a company gets bonuses, but no maluses. So the stock market now is down about, in Western Europe and the United States, between 20 and 50% in France. Okay, the stock market is down so much, but all the managers are rich. See, because they have the upside, that's asymmetry.
Upside, no downside.
So that asymmetry plus debt is going to blow up capital. It's not what it's meant to be. So unless and it doesn't look like, from what I see happening, this is going away. As a matter of fact, it's getting worse. Banks are benefiting even more from that asymmetry. They're making record money, and people are unemployed because of their mistakes. So those who are making the money are not paying the price of their mistake.
The circumstances that prevent them from taking a certain percentage of their assets and allocating it to something like a Universa, so that they are less at risk in that way.
They just don't have to do that. They could just avoid some trades. But let me explain to you the dynamics of the bonus system. And this led to my book, Skin in the Game, later on. If you have skin in the game, you're going to worry about blow up because it's your money. If you don't have skin in the game, you're CEO of a company or you're a fund manager, and any kind of financial venture, what is your incentive? It's to print good numbers, because you don't pay for the downside. So you print good numbers, you collect money on the profits.
Annual bonus.
Annual bonus. So this I call the generalized Bob Rubin trade. Generalized Robert Rubin trade. He made $100 million at Citibank or Citicorp, Citi something. Over 10 years, about 10 years, he collected $100 million in compensation. The bank was insolvent in 2008, near insolvent. It weren't for the taxpayer. And it was the last minute. All you had to do is, write an apology letter. We didn't see these events. It was a black swan named after a book by a very, very stubborn man. Okay, so something like that. So that's all they have to do is say, "I'm sorry," right? You keep your bonus.
And I'm in
you
the
don't
wrong
show
business.
up to work. So this you can generalize. It's the same thing with supply chain.
Mm-hmm.
With a supply chain, a lot of firms concentrated everything on one supplier instead of being diversified. What did that lead to, right? Okay, better bottom line, but what I call pseudo efficiency, because they're short that option. And it so happened that if their supplier is in Wuhan, guess what? You got a problem, all right?
You got problems.
That problem doesn't show in the numbers. It shows after it happens.
It's the dark side of optimization.
Exactly, what I call pseudo-optimization. Like if you drive a Ferrari 500 kilometers per hour, you're not going to get there faster than if you ride a bicycle. Because odds are you're never going to get there.